Sebi has announced new regulations allowing passive funds, including ETFs and index funds, to increase their investments in the listed companies of their sponsors. It has put out a circular with rules governing these increased investments. My colleague Shivani is joining us with more details.
Well, following the push by the mutual fund industry, Securities and Exchange Board of India has relaxed investment restrictions for passive funds. This comes in the form of a new circular. Previously, mutual funds could only invest up to 25% of their net assets in listed securities of their sponsors' group companies. However, Sebi has now amended its regulations to permit equity-oriented ETFs and index funds to increase their investment limit. These funds can now invest up to 35% of their net asset value in the group companies of their sponsors, provided they follow the weightage of the constituents of the underlying index. This change is particularly relevant for equity ETFs and index funds that are based on widely tracked and non-bespoke indices. Now, what is that? Widely tracked and non-bespoke indices are those that are tracked by passive funds or serve as primary benchmarks for actively managed funds with a collective asset under management of 20,000 crore rupees or above. Sebi has identified 21 such indices, which include prominent names like Nifty 500, Nifty 50, Nifty Midcap 150 and BSE 500 as well. These qualifying indices will be updated biannually based on the AUM threshold as of March 31st and September 30th. The Association of Mutual Funds in India, or AMFI, will publish the updated list on its website by April 15th or October 15th each year, after obtaining Sebi's approval. For passive schemes based on indices which are not included in this identified list, they must rebalance their portfolios within 30 business days. The industry has been advocating for the change, arguing that passive funds mirror indices and should not be burdened with the complexities of active management. Back to you.
Thank you, Shivani, for joining us with all those details. With that,